My name is Dan Dorval, and I'm President and CEO of Dorval and Cherney Financial Advisors. I am an independent certified financial planner and author of my book, Financial Success for the Rest of Us, Reality-Based Financial Planning for Mainstream America.
Hi, my name is Leah Woodley. I'm an associate financial advisor with Dorval and Cherney Financial Advisors. Our conversations discuss what it means to do quality of life planning in all areas of your life. Well, Dan, we're back on our messaging retreat. This is something that we do annually, so it's good for us to actually be together on camera.
Yeah, we never really get to see each other in person. Almost everything we do is over Zoom.
Yes, so this is great. We've had a great time of just brainstorming and thinking and talking about what matters to you all. So, one thing that came up is the difference in financial planning between those who may have more than enough money, where money is not a quality of life factor for them, and others who actually will need the assets that they have accumulated. Do you want to talk more about that?
Yeah, it's an interesting thing from, the way we do financial planning is always focused on quality of life. And so the vast majority of the people we help, they've done a great job of accumulating resources. They saved into their retirement plans. They are now at a position where they say, okay, I've accumulated this money. How do I now maintain quality of life for the rest of my life when I'm no longer working? And so much of our planning process focused on that quality of life is to align those resources as efficiently as we can to make sure it's sustainable for their whole lifetime. When we run across somebody that we help where they have so much money that they feel like, okay, my quality of life is fine. I don't have to worry about day-to-day fluctuations, anything like that. I'm more worried about legacy planning. How do I get this down to my heirs? Should I be doing charitable contributions? These two different approaches, it feels very different to a lot of people. And it's hard to differentiate. Like, we've talked before about people will see financial planners talk about wealth management. And when they do that, in many cases, people who are not in that situation are thinking, well, should I be doing what the wealthy are doing from a tax perspective or, maybe a charitable contribution perspective? And yet they're in a situation where they need their investments to produce income for them. And that is a completely different process. So we've had some discussions here getting together this weekend about as far as how we do that.
Yes, I think what you just said about there being that difference in those that actually need the income and those that may not need the income, it's really important to highlight that it can be dangerous if those who may actually need the income try to follow the things that those who don't need the income would do. First of all, those that have more income than they need, they can withstand more volatility than those who actually need their income. So we would invest differently and things like that. Anything you want to add to that?
So investments, we always talk about investments being tools to help people accomplish goals. And when we think about these two different types of goals, one more focused on legacy, one more focused on income and sustainable quality of life, those tools that we use are very different. So when you are taking income from your investments, and this is a question we get all the time, I've accumulated this money, how do I now turn it into income? We have a disciplined process for how to do that. And typically what you're doing on a simplistic basis is you want to have bonds to be able to buy time for your stocks to do their job. If I don't need time because I just have so much money that my investments are maybe for future generations or charity or whatever it happens to be, I'm much less concerned about that volatility because it doesn't have a direct impact on my quality of life. You could theoretically invest very conservatively, you can invest very aggressively, but there is no direct quality of life factor that is driving that decision making. So it's harder for us to give advice in that scenario. But for the person who's saying, I need this money in order to live off of and use daily for everything that brings me quality of life. That is a much more intensive, collaborative type of process. And that is what we do for people all day, every day.
Right. So, for those who may be in the situation where they will actually need their income, they've worked hard to accumulate it, what things should they be focused on?
So, the biggest thing is we have to be able to consider a worst possible scenario. So in the last 25 years, we know that there have been two stock market periods where the S&P 500 has gone down more than 50% of its value. If I am retired and I am now using my hard-earned, hard-saved dollars in order to provide income, and if I'm 100% invested in the stock market and I experience a 50% plus decline in my investments, it is virtually impossible for us to be able to come back from that when we are also taking out money at the same time. This is called sequence of returns risk. When I am accumulating money, so if you're in your 20s, 30s, 40s, you're accumulating retirement funds, you're putting money in. So when you experience those declines, you're buying at a cheaper and cheaper and cheaper price, and eventually it goes back up because you have time. Now that volatility didn't hurt you, it actually helped you along the way. When I'm taking money out, volatility can be devastating to my overall financial plan. So our job is to position your investments in such a way to help mitigate that potential risk of such a serious decline right when you need that money the most. We have to have a process in place to deal with that. And most people just simply have never thought through that process in a disciplined way. So when they experience maybe the recent volatility we've had, kind of the chaos, they get this anxiety, they get this sense of foreboding, like I'm not sure my money's going to last, and then they don't know what to do.
Even outside of retirement, just investing for those midterm goals or even those short term goals, I think it's important to be clear about knowing what the money is for. And that's something that you always stress. And that's something that is very important as well, because that's going to dictate how we would plan for those funds.
Yeah, I mean, if you're investing for college and your son or daughter is maybe a teenager and they're only a couple 3 years away from needing that money, you have a very condensed time frame, because not only do you have a short time frame until they're going to start to need the money, but they might only be in college for 4 years or whatever it happens to be. And so you're going to use up that college money in a very short period of time. If it's retirement, we don't know what that time frame is, but it certainly could be 2 or even 3 decades of needing that money to last. That is a very different process based off of that purpose and that meaning for that money.
I want to shift gears and talk about the person who does have more than enough money. What considerations should they be making? What should they be thinking about?
So, a lot of times the conversations there are more complicated, meaning we will ask them, okay, what is this money for? And they kind of think about it and they go, I don't know. I mean, I want to leave money to my kids or my grandkids, but I don't want to leave them so much money that it feels like now they didn't have to work their way on their own. And so people have those challenges. They might want to leave money to charity, but then they don't really know, well, how much should I leave to charity? Which charities? Is this really what I want to do? So these conversations are more of like they'll happen over time, where people will say, maybe I'm not entirely sure right now. And the problem with a lot of the techniques that are associated with very high net worth people, so you might be talking about a donor advised fund if we're talking about charitable giving. You might be talking about that in conjunction with Roth conversions in order to mitigate some of the required minimum distributions on IRA funds. When we get into those approaches, they tend to be a little bit more permanent in nature, meaning I've done this technique, it better fit what I'm doing. And so we will tend to take a more measured approach and say, okay, we've had this conversation. let's think about this for a while before we just jump in and do it.
That is really, really important to do.